So with that, I will turn it over to Dan.
Thanks, John. Appreciate it. And it's good to be back with Community Veterinary Partners. As John said, it about 11 years ago, myself and two partners, Michael Raphael and Mark Nathan, co-founded Community Veterinary Partners. And although we are not involved anymore since Community Veterinary Partners was recapitalized about a year ago, I still consider it, in a sense, one of my children. I have three daughters and then CVP. And the thing I've joked is that so far the only one of my children that's made me a dime has been Community Veterinary Partners. So it's good to be back. I want to quickly take you through a set of slides about a little bit about what we think in Terravet real estate is important, about how veterinary owners can think about their real estate as distinct and linked to their practice. And also talk about how do you understand how real estate's valued, how can you think about maximizing it. We'll leave plenty of time for questions. If I'm moving a little quickly, make sure to note a question and I'll try and come back and answer. That's me. So just very quickly, 30 seconds about who Terravet, what we do at Terravet. Terravet's a veterinary real estate business I founded about really 4 years ago. We own veterinary real estate in 24 states, leased to about 20 different unique operators, independent veterinarians, and primarily corporate operators, including Community Veterinary Partners. We own today, between buildings owned and under agreement, we have about 90 buildings and growing. We are delighted that we have committed equity and debt capital from leading banks and from leading billionaire family offices. The Pritzker family out of Chicago is our lead investor. And one of the things that we always say is that, as all of us on the phone know, is the veterinary sector, great sector, but reputation is so important. It's a small world, as we all know. So since we're focused on veterinary real estate, we understand, we think how we can work with veterinary owners, how to, treat confidentiality and discretion as primary. And we think hopefully that helps us to do what we do, which is, again, we don't own any practices. We own real estate and lease it to veterinary owners. We also do a bunch of renovations and expansions. We're right now working on about 7 or 8 building projects within our existing buildings in different states. And if that's of interest, we can talk about that too. So the agenda for tonight, why does it matter what your property's worth? How do you think about appraisals? What are some tips for dealing with appraisers? And then how can you increase your property value? Does the lease impact your value? And while you own, what do you do to increase the value of real estate while you own your practice? And when you sell your practice, how do you think about that? How do you think about value? So we always say there's 2 major assets that most veterinary practice owners own, which is their practice and the property. It's important, we think, to understand the value of your assets, right? We also think that the more you understand the value of your real estate, the more you have options and tools, arrows in your quiver, to actually apply that to increasing the value of your practice or to just enjoying life more. What do we mean by that? Look, one of the opportunities that a lot of veterinary real estate owners and practice owners have is to tap the value of the property to be able to borrow and to do stuff with that borrowing, to invest in the practice, to invest in something you want personally, the lake house or the new exam room, whichever one it is. And in order to do that, in order to refinance and take on more debt, in order to do it the most effective way you can at the best pricing, you're going to need to have an appraisal. And so we're going to spend some time initially talking about appraisals, because the goal usually is to maximize the appraised value of your real estate. And then that gives you options about how much debt you might want to try and take against that appraised value. Then we're going to turn to maximizing the sale of your real estate at a point that a veterinary real estate owner is interested in selling. We're going to talk about what drives value and make sure you get some good advice. And what I just want to say at the outset, and I think this is always true, we'll talk about, a little bit more about, the value that a corporate owner of your practice adds to the value of your real estate. But when I say get good advice, there are a lot of people in the real estate sector that may give you advice. You want to find specialists, accountants, lawyers, real estate brokers that really understand the sector. We think, as an owner, we are one of them, but there are others, and we'd be happy to let you know who we think's good and who we think's not. So as a follow-up. All right, let's talk about appraisals. First thing to understand, property appraisals are really driven by banks. The goal is for a bank to do a little bit of CYA, to cover their backside by having an appraiser appraise, which means they tend to be conservative. And banks are and appraisers use various methodologies and metrics in order to get to their appraised value. But we found that appraisals are funky for veterinary properties. And the reason, we'll go through some of the reasons, but really it boils down to the fact that veterinary real estate is not cookie cutter, right? No building looks the same, and no practice is the same. Whereas, an appraiser that knows about garden apartments, or appraiser that knows about appraising Chick-fil-A's or Burger King's, they look very similar. And so when appraisals start looking at veterinary real estate, they get really confused, and they sometimes make mistakes that are not in the favor of the owner of the real estate. So one of the other issues is that appraisers really don't have much appreciation for the stability of veterinary practices. So we all know how well veterinary practices performed during COVID-19 and through recessions. Appraisers do not have any understanding of the best comparables to use. So one of the things we'll show you is that often the way appraised values work is they look for comparable buildings. And the question is, what should they use? If they only use veterinary buildings, how many sales or leases of veterinary buildings are there within a reasonable radius of your building? Probably not many. And so we've seen appraisers do crazy things like going 100 miles away or 5 years ago. It's not clear whether appraisers should look at retail real estate or office real estate, and there are just not a lot of transactions, and there's not a lot of experience. So how do appraisers handle it? 3 methods that they use. Often these methods are blended or averaged to come out with their appraised value. The first is the cost approach, then the income approach, and the sales comparison approach. Cost approach is the easiest to understand in many ways, and in a lot of ways the least useful for a veterinary practice real estate a building that's been there for 20 years. It basically says if the building were knocked down, if there were a fire, what would it cost to reconstruct a similar building, similar quality, land and building? What's the replacement cost? Again, not that useful because it's only really relevant if you're developing. If you're going to buy the real estate, it's sort of useful to know what it would cost to replace it, but it's not really an approximation of value. The next approach is what's called the income approach. This is the approach that I think, we believe is the best, is what I would say most real estate investors focus on. And this basically says, how do I think about the value that I can get out of owning this real estate as an investor? If I buy the real estate, what multiple of rent do I want to get? Do I want to pay? Or said differently, what kind of cash yield do I want to get based on the rent that I could collect as the landlord of real estate that is leased? There are a variety of questions, and we're going to introduce a term that's used in real estate that gets confusing, but really isn't that confusing. We'll try and unpack it, which is capitalization rates. I'm going to show you in the next slide or slides what a capitalization rate is, but basically what you want to understand is if the rent is set close to market, and if you know what the capitalization rate is, then you can understand how an income approach would value the real estate. So what's capitalization rate? So a capitalization rate is just a relationship between the rent and the property value. Another way to think of it is that it is the return that a buyer of the real estate would want to get in rent on an annual basis. So look at our example. If we buy the property for $1 million and the rent is $100,000, and here we're talking about net rent, but annual net rent is 100,000, we would say that's a 10% capitalization rate. And depending on how risky the investor, the real estate investor, looks at the prospect is going to mean how much more they would want in a return. So, for example, if we're talking about a Walgreens that is guaranteed by Walgreens, that is brand new and has a 20-year lease, that's going to probably not need to get me a 10% return. That might be a 5% return, right? Because it's really not risky at all. I can kind of bank that money. Walgreens is going to pay. So capitalization rate and income approach. The income approach is an important one to understand. And one of the things I'll just say, and we'll show you on the next slide, is one of the things that's confusing about to people about capitalization rates is that lower capitalization rates mean higher property value, right? So it is the inverse of a multiple. Most people in veterinary medicine, particularly looking at selling practice, are now very familiar with multiples of EBITDA or earnings. A capitalization rate is just the inverse of that. It's rent divided by that capitalization rate percentage. That equals the value, right? 100,000 divided by 8% equals 1.25 million, right? The next slide is, I think, helpful in that it's actually helpful, I think, if capitalization rates get confusing, to convert the capitalization rate into a multiple, because again, it's just an inverse multiple, right? So 1 divided by 8% is 12.5 times, right? And so really an 8% cap rate is just another way of saying 12.5 times multiple of the net rent, right? A 9.5% cap rate is another way of saying 10.5 times the net rent, right? So this approach is very standard across a lot of real estate. People will talk about capitalization rates, and it's tied to this income approach. The last approach that appraisers use is called a sales comparison approach. And this is helpful because what you're really looking at is if you can look at what the per square foot sale value of real estate is in your area. What have comparable buildings sold for on a per square foot basis? Then you can say, well, whether it's a veterinary practice or it's a car dealer or a tire distributor, this is what real estate investors in this area are paying per square foot. The challenge on this, of course, is, it's not really comparable to talk about a tire distributor and your veterinary practice. What exactly are the market? And because there really are no similar buildings, what appraisers do is they're kind of comparing apples and oranges, and they'll just sort of use this approach to kind of wiggle their way into a value. And so we'll just show you very quickly, this comes from a real appraisal on the next slide. This is an appraisal that we looked at. And it's pretty clear that what the appraiser wanted to get to was a value of about $300 to $350 per square foot. And then back into a value based on the square feet. If it's, if it was 3,000 square feet, right, $9 million, in terms of value, right, or 900,000 in terms of value if it was 3,000 square feet. So what's interesting here is if you look at the comparables that are being used, the first comparable, number one, they show up with, it's $589 per square foot, and the third is $483. And then what the appraiser does is, what I think is kind of BS, is they just, change it. They sort of adjust it, and they say, well, the building's, too big, so we're going to reduce the value by 40% here, and we're going to adjust it here. So we are not fans of the sales comp approach. We do think it's a good check to look and to understand what the per square foot value of other buildings in your area are, but we don't think it's the best way to do it. All right, I'm going to shift, and again, we'll have time and questions to come back to this stuff, but I want to make sure we make it through. We're going to talk about ways to improve the value of your practice using your building, right? So, again, I'm going to move quickly through this. Many of you guys will know this, but if you can borrow against your real estate, you can actually invest in resetting the flow or expanding the space or expanding for parking and making sure that you have enough room for growth. You could invest in revenue generating spaces. You could build more exam rooms. You could figure out a dental area, in-house lab. And ultimately, one of the things we see a lot of groups doing, a lot of practices doing, is redoing your reception area and building out room to make sure that your facility is attractive to hire more doctors and staff. The point really here is that if you have value in your real estate and you haven't borrowed fully against it, one of the best things that you can do is borrow against the value in your real estate and invest it in revenue generating areas and ways in which you can make your practice stronger. So then let's talk now quickly, top 3 ways to improve the value of your veterinary building, right? So these are things that often people don't always think about. They are just little nuggets that we've seen. One of them is to think about acquiring or putting an option on an adjacent lot. We see a lot of situations, and I would think the folks at CVP see this as well, where a practice, is in a building that's a little bit small for them, and the parking's tight. There's not a lot of room for growth, and the problem is that there's not vacant land or area around them to build out. And often in talking to veterinarians, they'll say, well, I had an opportunity 20 years ago to buy the extra lot next door, but I didn't want to spend the money on it. I didn't do it. One of the thoughts we would have is either think about acquiring adjacent land, or one of the things a lot of people do is you can put an option on land. You can pay the adjacent real estate owner a small amount per year to make sure you have the first option to buy that real estate. Worth thinking about. It could pay dividends in the future. Another thing that's really important to think about if you're a veterinary real estate owner is there are some really great tax strategies that allow you to reduce your taxes. One of the smartest things to do, we do it on all our buildings, is to do something called a cost segregation study, which allows you to identify aspects of your building that have a useful life that are less than 15 years or 10 years, and it allows you to depreciate those and to shield taxes. Totally worth looking at if you own your building. A third thing I would just say is explore value add opportunities. We own, I think, 2 buildings that have solar panels and 3 that have cell towers. But all of this can be really nice opportunity depending on what state you're in. Solar panels and energy efficiency, in certain states, there are incredible tax credits on it. And cell towers, especially with the new cell services coming, there's a lot of smaller towers that are going to be needed, and so it actually is something that really worth looking at doing. It can add $10,000, $20,000 of cash flow to you in terms of rent that you're collecting from the cell tower company. All right, we're going to turn to not an appraiser, but how does a real buyer determine the value of your property? What are the ways that we at Terravet or other buyers would really be looking at? What are the things that matter to us, right? And we're going to run through a few different ones and then just outline them again so people remember. But first is a physical evaluation, right? Is the building up to date? Is there room for growth? And then, parking is a huge issue often. And then there are other little things you may want to think about now. Are there easements? Does someone have a right of way that's sitting, that is buried, they haven't thought about for years and years and years, but will come up if you sell the real estate? Was the real estate previously a gas station? You'd be surprised how many veterinary practices are in former gas stations. Are there buried gas tanks? Are there environmental issues? So, there are things you want to think about looking at the physical plant of the building. Location is obviously critical, right? If you're in a strong suburban area, near a major metro, that can attract veterinarians, that has enough density for clients, it's going to be, your real estate will end up being worth more. And you want to understand that, right? If you're in more of an exurb or even a rural area, it doesn't mean that your real estate can't be worth as a multiple of the rent, similar to another practice. It just means that there are other things that become even more important. Lease quality evaluation. This is something that I would say is one of the most important things I'll get across. The value of your real estate isn't just your building or your location or the land. Because veterinary practice real estate are encumbered by a tenant. Said differently, they have a tenant called your veterinary practice. And if you were to sell your veterinary practice, whoever buys the practice, be it an associate or a corporate group, they're going to have the right to use that real estate. So the strength of your lease makes an enormous difference in terms of the value of the real estate. And in addition, the other thing that makes an enormous difference in terms of the value of real estate is who is the tenant and whom is the guarantor of that lease or of the tenant. So let's stay on the tenant for a second. And here I'll be just very direct. Selling to an associate may be the right decision, but it is definitely not the one that is going to create the most value for you from a real estate value point of view, separate and apart from the value of the practice. And the reason for that is, as a buyer of real estate, if I have a corporate guarantee from a strong company like a Community Veterinary Partners, the value of that tenant Community Veterinary Partners and their credit with 80, 90 hospitals is just so much bigger than Dr. Smith, veterinarian. And that actually impacts how much I will pay for real estate, how much almost every serious real estate buyer will pay. But it's also important to understand, you want to make sure that if the actual corporate group isn't the tenant, that they are the guarantor, that they guarantee the lease. A lot of corporate veterinary groups will set up special purpose entities to buy practices. Nothing wrong with that, makes great sense. But most good corporate groups, including Community Vet Partners, will agree, if you ask, if you negotiate for this, to have the lease guaranteed. And I'd be very suspect of a group that wouldn't guarantee the lease. It changes the value of your real estate. An additional piece we want to talk about, and this is important, is what is the rent compared to the local market rent. And so there's an old rule of thumb in veterinary operations that rent ought to be set around 4 to 6% of gross revenue. That's, I think, fine from an operating point of view. If it's lower, I think most groups would be fine with that. One other question from a real estate point of view is the rent at or below market? Is the practice rent $33 a foot when the market of other properties down the block is $15 a foot? If the rent is set too high relative to the market, it creates risk for a buyer of the real estate, because if, God forbid, the practice is moved or doesn't re-up after the lease is over, then they're going to have bought a practice based on a multiple of inflated rent, and that creates risk. So where your rent is set compared to market is important. One of the things we do at Terravet all the time is we do market rent analysis for a whole bunch of veterinary real estate owners. We're happy to do it for anyone who's on the call at any time. It's easy enough for us to do. And here, one of the things you want to understand is what's the local market, value, and you want to really look at what are the values per foot in the area, what's recently been sold, what's close by, and you want to think about what are the reasonable comparables. Is there a building that is a retail building that is half a mile away versus an office building? Is it similar size? When thinking about the comparables, it's important to try and really find things that are similar. So let's do just an example. I kind of alluded to this earlier about how different, how in fact a practice that is of the same revenue and same earnings can actually have, because of the different buildings and location and lease, can end up having dramatically different values, right? And here, my example is outside the vet space. Let's assume a Walgreens that's in a good building, in a good location, suburban area, 20-year lease, rents at the market. We might pay, or a real estate buyer might pay 20 times the net rent. Versus if it's an independent pharmacy owner named, Pharmacist Smith, they're in a very rural area. It's an old building. There's a 5-year lease. It's way above market, right? Maybe we pay 10.5 times rent, right? So the difference in my example is a huge amount of capital. This is just a quick slide to talk about what matters most in leases. And what I'm going to say here, and this is, I think, an important thing to just understand, is that there are 3 top things that I think you want to be thinking about if you're selling your practice to an associate or a corporate group, that you want to make sure you negotiate for in the lease. The first one is as long as an initial term as is reasonable. In the veterinary sector these days, most good corporate groups will start with a 10-year lease. Some will go longer. There are still groups that will offer 5-year leases. 5-year leases are not helpful because most serious real estate buyers want to see at least 7, 8 years left on your lease term. And here we're not talking about what the renewal options are. I'm talking about the initial lease term. The second we've already covered, which is if the tenant is an individual or if the tenant is a special entity, CVP of Conshohocken, Pennsylvania, not Community Vet Partners, then you want the corporate group to guarantee the lease. And finally, one of the negotiations on leases is about what expenses remain for the landlord. Everyone in the veterinary sector says that they do triple net leases. The best corporate groups out there, CVP included, will do what we would call, close to absolute triple net or modified triple net. And by that we mean, and everyone agrees on the first two, the property taxes are the responsibility of the tenant. That's the first of the 3 triple nets: net of property taxes, net of insurance. The insurance is on the tenant, property insurance. And the third is maintenance responsibilities. And here's where this gets to be a little bit more contentious. We think it's totally appropriate to negotiate where the landlord is responsible for replacing the roof and the structure of the building. But there's a lot of groups out there that will ask for the walls and the parking lot or the HVAC. We actually think that really should be a responsibility of the tenant. And it's really just a negotiation as part of the lease negotiation. Quick example about how leases make a difference. In what we're assuming here, a practice which is basically got which is similar practice, right? And what we're really seeing is rent of $80,000 in both practices, $80,000. And let's assume they're in identical locations, right? In one case, there's a 5-year lease. The other one's there's a 15-year lease. And in one case, there's an individual hospital operation. In the other, there's a corporate guarantee. In one case, there's all sorts of responsibilities, replacing the parking lot, HVAC, and the other one, it's just the roof and the structure. And then, when you come down here, what we're really saying is, on the one with the longer lease, with a corporate guarantee, with less responsibilities, we're pretty sure in this market that you'd get 12.5 times rent or an 8% cap rate. Whereas the other one, you might be able to get 10 times. So the difference in our example is a couple $100,000 in value just based on how the lease was negotiated. One of the other metrics that we look at, that serious real estate investors look at, is how much cash flow does your practice generate to cover the rent? And here we talk about a ratio of EBITDA to rent. EBITDA is EBITDA, or your practice profit, plus rent divided by rent, right? So $2 million practice in our example, 240,000 of EBITDA, right? So 12% margin. Rent is set at $100,000. The way we get to this is we say EBITDA is 240 plus 100, or 340,000. And so that covers the 340,000 divided as the numerator with 100,000 as the denominator. There you've got 3.4 times coverage. What we would tell you is this is often a factor that is strong for profitable veterinary practices, and it's a good factor to be able to sell off of, but people don't often think about it just because veterinary practices tend to be profitable. We look for over 3 times. Over 4 times is a really strong coverage. And many veterinary real estate owners have that kind of coverage. Couple last thoughts about how do you increase the property value. One of them is increase the rent. The easiest thing you can do. If you own the building and the practice, you may want to increase the rent. Now, keep in mind, if you increase the rent, but the rent is higher than market, you may run into problems. So you really want to do this to be within market. You also don't want to increase the rent so much that it's not within that 4 to 6% of your revenue, because then it's going to make it much less valuable and less profitable as a practice. But if you have rent that is below market, it may be that it's a good idea to increase that rent, because again, a lot of the real value of your real estate, especially with a lease in place, is going to be a multiple of that net rent. So quick last thought, and then I'm going to pause in a moment and take questions, and we can go back to anywhere in the presentation where there was important issues where I may have gone too quickly. But 3 key factors of your property value. This is not for appraisal purposes. This is for a real buyer. The first is rent. Is your rent set close to what the market is? Is it reasonable in terms of as a percent of revenue for the operation? Is there room to increase the rent? Is the lease well negotiated? And really important, do you have a good tenant? And do they have good credit? Is it a CVP, or is it Dr. Schlabotnik who's got $500,000 of debt and no experience operating a veterinary practice? I don't want to be unfair, but the value of the real estate is much greater if it's a CVP or a strong corporate group than the young associate. That doesn't mean, by the way, the associate won't be a great operator, and it doesn't mean we wouldn't necessarily buy the building. It just means it's another thing to overcome. And then the third is what's the location and what's the state of the building? Because at the end of the day, we are talking about buying real estate that is the dirt and the building, and so that matters as well. You can definitely reach out to me. You can find us on the web. You can also reach out through CVP. They know where to find me. And I'll just put up CVP's last slide. Thanks for attending.